completely different movies on the exact same screen. Today, U.S. equities are popping champagne over a flawless inflation print while, literally ignoring live military exchanges.
Yeah, and a reinstated naval blockade in the Middle East. It's wild. It is the ultimate collision between the virtual economy and the physical economy.
Welcome to this deep dive. I'm Daniel.
And I'm Mira.
Usually when we look at the daily tape, the market narrative is fairly unified. But today, we're unpacking a day of severe, almost unprecedented market whiplash.
We really are.
We're breaking down a massive June inflation victory, Federal Reserve Chair Kevin Warsh's immediate pivot to cool expectations, and the escalating brinkmanship in the Strait of Hormuz.
Plus, we are going to look under the hood of the Q2 bank earnings that just kicked off.
It's a phenomenal setup to analyze because the underlying mechanics of how investors are pricing risk right now are, they're shifting in real time. And before we get into the mechanics, a quick reminder for you listening. This deep dive is for market context and discussion only. It is not personal investment advice or an investment recommendation.
Right, definitely keep that in mind.
So let's jump right into the timeline. Session 1. So what set the stage before the U.S. session?
Well, Daniel, to understand the sheer velocity of the U.S. Open, you have to look at the carryover narrative from Monday, July 13th.
Right.
The geopolitical backdrop coming into the week was incredibly tense. Over the weekend and into Monday, the U.S. launched massive drone strikes on Iranian coastal targets.
And the response to that was immediate, right? Iran retaliated with intense drone and missile attacks on U.S. bases in Kuwait and Bahrain.
Yeah, so we basically went to bed on Monday with the very real fear of a spiraling regional conflict.
But then, pre-U.S. Open, on Tuesday, July 14th, the market gets hit with this sudden, unexpected wave of overnight relief.
Which was huge.
At 5:18 a.m. Eastern Time on Tuesday, President Trump posted on Truth Social that he is officially abandoning his highly controversial proposal to levy a 20% cargo transit toll on ships passing through the Strait of Hormuz.
And the ripple effect of that policy shift is massive. He is opting instead for bilateral trade and investment deals with various Gulf Arab states.
Makes sense out of us.
Well, if you think about the mechanics of a 20% transit toll, that is an instant punitive tax on a massive chunk of global energy transport. Shipping insurers would have to hike premiums aggressively.
And that cost just gets passed directly into the global supply chain.
Exactly. By dropping the toll and focusing on bilateral investments, you shift the burden from corporate margins to state-level capital flows. For energy shipping companies, it removes a major regulatory cost penalty overnight.
Wow, and that relief in the energy sector coincided with another massive catalyst on the other side of the world. While Middle East was dealing with missile intercepts on Monday, the AI supercycle was flexing its muscles yet again.
It really was.
Late Monday night, at 10:02 p.m. Eastern Time, China Customs released data showing their June dollar-denominated exports soared 27% year over year. That created a record $125.8 billion trade surplus.
The crucial takeaway there isn't just the size of the surplus, but the composition. Chinese officials explicitly cited steady, robust demand for computing power, data centers, and terminal devices.
So AI is still driving the bus.
Yeah, it proves that the massive physical investment cycle for artificial intelligence is still underpinning global trade.
Which makes perfect sense when you pair it with what happened just over an hour later. At 11:25 p.m. Eastern Time on Monday, the U.S. Commerce Department confirmed that select Chinese buyers,
specifically companies like ZTE Kingston,
right, they are now formally approved to purchase NVIDIA H200 AI chips.
That provides critical regulatory relief for tech suppliers. The market looked at that and realized the global AI infrastructure deployment can continue to expand without being completely choked off by trade restrictions.
The supply chain is holding together, and you can see that optimism bleeding into institutional positioning. We saw the Bank of America Fund Manager Survey drop at 3 months EM Eastern Time on Tuesday.
What did it show?
It revealed that a record 54% of global fund managers now expect a no-landing economic scenario.
Right, and for context, a no-landing scenario essentially means the economy keeps growing and inflation might stay a bit sticky, but absolute growth simply outpaces the pain.
Which is a pretty bullish view.
It is. Managers are looking at AI CapEx as cycle agnostic. It's a force so powerful it just drags the broader economy upward regardless of what interest rates are doing.
Yeah.
That's why 82% of those surveyed identified long global semiconductors as the world's most crowded trade.
Okay, Mara, here's where I have to step in and challenge this setup.
Yeah.
Because I am looking at this positioning, and it feels deeply disconnected from reality. The market is treating long global semiconductors as a one-way ticket. But we frequently discuss geopolitical escalation as game theory brinkmanship. It feels like investors are treating the conflict in the Middle East like a passing thunderstorm.
Like an unpredictable natural disaster that will just blow over.
Exactly. They are entirely compartmentalizing the physical risk. A hot war in the Gulf is a structural threat to the physical supply chains that this AI hardware depends on. You can't build billion-dollar data centers if the global logistics network freezes.
That's a very fair point.
How can 82% of managers be overwhelmingly long on semiconductors while ignoring the powder keg that fuels global manufacturing? It's like spending billions to build a state-of-the-art server farm, but ignoring the fact that the only fuel supply line to your local power grid is currently a live fire zone.
It's a massive assumption of rational behavior in an irrational environment. The market is betting, through a game-theoretic lens, that the posturing in the Gulf won't result in a permanent logistical freeze, because a freeze hurts everyone economically. They are pricing in the soaring demand for AI compute, while heavily discounting the risk of a physical supply chain disruption.
So that overnight setup, a massive sigh of relief from Asia trade data and the canceled Hormuz toll, completely papering over the live military conflict, it sets up a wildly bullish posture.
It really does.
But as the sun comes up in New York, the actual domestic economic data hits the tape, which brings us to session 2. What moved markets during U.S. trading hours?
Well, the defining macroeconomic moment of the day happened right at the opening bell, at 8:30 a.m. Eastern Time.
With the release of the June Consumer Price Index report.
Yes. It was the best inflation print the U.S. has seen in 6 years.
The numbers were a shock to the downside. Headline CPI dropped by 0.4% month over month, bringing the annual rate to 3.5%.
But the real institutional focus was core CPI.
Exactly. It completely flatlined at exactly 0.0% month over month. That brings the annual core rate down to 2.6%.
That flatline is incredibly significant for institutional models. The White House immediately celebrated the print. And for the market, it meant that lingering fears regarding central bank rhetoric and demand destruction simply vanished.
The reaction was wild. You saw S&P 500 futures immediately rip to a high of 7,613.75.
And Nasdaq 100 futures hit 29,921.75.
The 10-year Treasury yield fell to 4.585%, and the U.S. dollar index weakened.
But the mood in Washington was decidedly less celebratory, because at the exact same moment,
8:30 a.m. Eastern Time.
right, while the market was bidding up equities on that flawless CPI print, Federal Reserve Chair Kevin Warsh was delivering his testimony to the House, and he used that platform to completely overhaul how the Fed operates.
He announced 5 new task forces aimed at revamping the Fed's 2020 framework. They are specifically targeting their communication, balance sheet, and how they model inflation.
It's like the Fed realized the GPS they used to navigate the 2020 crisis is now leading them into oncoming traffic, so Warsh is literally ripping it out of the dashboard to install a completely new radar system.
That's a great way to put it. And he was blunt about the data we just saw. To quote him directly, "Mission accomplished is not my view after today's data."
Wow.
Yeah. He stressed absolute data dependence and explicitly stated they have zero tolerance for persistently elevated inflation.
He is attempting to rebuild the Fed's credibility by refusing to take a victory lap on a single data point. He is looking at the structural stickiness of the broader economy, while the market is just trading the immediate dopamine hit of a 0% core print.
And this is where the day crossed into full cognitive dissonance for me. Because while traders are popping champagne over inflation data, the U.S. military formally resumed the total naval blockade of Iranian ports at 4 p.m. Eastern Time.
We were watching live warfare unfold during market hours.
Exactly. There were reports of U.S. projectiles hitting Qasem Island and Sirak. The Kuwaiti army intercepted 33 drones and 6 missiles, and a Kuwaiti Navy vessel was actually targeted.
And while equity markets seemed blind to it, the commodities market felt every ounce of that physical tension. Gold staged a massive $120 intraday swing, plunging to 3,990.40 before rocketing back to settle at 4,058.40.
WTI crude swung wildly as well, ultimately closing up at $79.83.
Look, Daniel, I am staring at the terminal, and equities are soaring while the Gulf is effectively being sealed off.
It's completely disjointed.
It really is, and we have to look critically at the market's timing here. Equities are celebrating a flawless CPI print, but that data is inherently backward-looking. It tells us what happened in June.
Right.
With the total naval blockade now active, we have to talk about the forward-looking reality of oil and diesel shocks as a logistics tax.
Walk me through how that flows into the data.
A logistics tax doesn't update on a Bloomberg terminal the second a blockade is announced. It takes time. Freight insurers hike their premiums, tankers reroute entirely, and the sheer cost of moving physical goods skyrockets.
Because it's delayed effect.
Exactly. That tax bleeds into the physical supply chain over weeks. So I have to wonder if this rate cut euphoria in equities is just drastically mistimed. If the Gulf is shut down, that logistics tax will inevitably bleed into next month's core numbers, which could completely unwind the 0.0% victory we saw today.
That is the crux of the split screen market. Investors are betting heavily that macro shocks won't trump micro fundamentals. They're buying the backward-looking inflation win and putting the forward-looking logistics nightmare on mute.
They really are.
And that dynamic transitions us perfectly into our final segment, Session 3. Let's look at the corporate events recap and what to watch next.
Tuesday was vital because it marked the kickoff of the Q2 bank earnings season, starting at 6:32 a.m. Eastern Time. We heard from JP Morgan, Wells Fargo, Bank of America, Goldman Sachs, and Citi.
And since banks are the ultimate barometer of capital flows, their commentary sets the baseline for the entire quarter.
Yep. The overwhelming consensus from the banks was that the U.S. consumer remains highly resilient. There is no sign of broad demand destruction, and the market is extremely risk-on.
But the really fascinating insight came from Goldman Sachs CEO David Solomon.
Yes. He highlighted that the trend of AI capex operating as cycle agnostic is actually expanding outward. Capital needs are moving far beyond core tech and bleeding heavily into physical infrastructure and energy.
Because you have to build this stuff to run the chips.
Exactly. The sheer amount of electricity required to power these data centers is forcing massive investments into the power grid itself.
Which brings our entire geopolitical conversation full circle. If AI requires a massive expansion of the physical power grid, then global energy security is the ultimate bottleneck.
And we saw a major policy move addressing exactly that at 11:14 a.m. Eastern Time. President Trump and Iraqi Prime Minister Ali al-Zaidi announced a strategic energy partnership.
Trump noted that U.S. firms are going in to, quote, take a lot of oil out of Iraq. And alongside that, the U.S. confirmed a full troop withdrawal from Iraq by September 30th.
But the structural shift for the market is what they are building. The U.S. is officially backing the reconstruction of an Iraq-Syria oil pipeline.
Wow, an Iraq-Syria pipeline.
Yeah. If you look at the geography, this is infrastructure bypass surgery for the global oil market. A functioning Iraq-Syria pipeline allows crude to completely bypass the Strait of Hormuz.
It is a direct, long-term hedge against the exact geopolitical choke point that had commodities whipsawing all day.
Completely.
It's incredible. With core CPI flatlining at a beautiful 0% today, investors were ready to pop the champagne and celebrate a historic victory over inflation.
Right, until they looked up from their screens.
Exactly. They realized the only thing more explosive than tech stocks was the actual military situation in the Strait of Hormuz.
Yeah, and Fed Chair Warsh warned us not to declare mission accomplished just yet.
Which is probably wise, since it's hard to hear the closing bell over the air raid sirens in Bahrain and Kuwait.
It really is.
But hey, look on the bright side. Our stock portfolios are finally cooling down, even if the Persian Gulf is actively on fire.
That truly captures the absurdity of the day. The screen is bright green, but the physical map is bright red.
So to figure out which of those realities holds up, what do we need to watch for in the next 24 hours?
Wednesday, July 15th is packed. At 8:30 a.m. Eastern Time, we get the June Producer Price Index, or PPI.
That is the wholesale side of the equation.
Right. We need to see if wholesale prices confirm today's disinflation signal or if pipeline pressures are already building. We also get the NY Fed Empire State Manufacturing Survey at that exact same time, which will give us an early read on regional factory activity.
Then at 10 a.m. Eastern Time, Fed Chair Warsh is testifying again, this time before the Senate Banking Committee.
Given today's naval blockade news, the key will be watching how he responds to direct questions about oil-driven inflation risks.
Definitely. And before the market opens tomorrow, we have a massive slate of corporate earnings. Financials and healthcare giants like Morgan Stanley, BlackRock, and Johnson & Johnson report alongside United Airlines.
But the most critical print is ASML. They provide the lithography machines that literally build the AI revolution. Their earnings will be the ultimate read-through for that crowded semiconductor trade we debated earlier.
Finally, at 2 p.m. Eastern Time, the Federal Reserve releases the Beige Book.
The Beige Book is fantastic because it isn't just hard numbers. It's anecdotal.
Right.
It provides district-level insights into exactly how businesses across the country are navigating shifting consumer demand and volatile energy costs on the ground.
It will be a highly consequential 24 hours to see if the gravity of the physical economy finally catches up to the virtual economy.
I'll be watching the terminal closely.
And that brings us to a final thought for you to ponder as we wrap up this deep dive. Today was a masterclass in market compartmentalization. But going forward, are we moving into a completely new regime where macro shocks trump micro fundamentals entirely?
It's the big question.
Where the physical reality of global conflict and supply chain bottlenecks eventually breaks the back of corporate earnings? Or will the sheer momentum of the AI infrastructure supercycle continue to pull the market upward, operating completely detached from the physical reality of a burning Middle East?
It is the ultimate collision. Can the virtual economy of algorithms and data centers outrun the physical economy of shipping lanes and oil barrels?
That is the defining question for the rest of the year. Let us know what you think the market is getting right or getting completely wrong. Share your thoughts in the comments below, and we'll see you for the next deep dive.